Ciao, and welcome to another episode of the Real Estate Podcast with me, Nico James Bach, a broker at Royal LePage Signature in downtown Toronto. In today's episode, I want to talk about the July 2023 market stats and provide you with 5 takeaways, real takeaways from those stats. I want to first talk about the most recent headlines that came out shortly after the TRREB stats were published on August the 3rd. The headline was, "The average price of a home in Toronto has plummeted by 6 figures this year." This type of headline is designed to grab attention. It goes on, the article goes on to say that even if realtors and developers want to believe that Toronto's real estate market is holding strong in the face of record inflation and sky-high interest rates, the steep downturn in sales volume and now declining prices tell a different story. So what story are they telling? So it goes on to say that looking at the same data points from 2022, we can see that there had been 51,940 sales by this time last year, with an average price of $1,239,104. It is noteworthy that the 2022 charts in their actual report skewed slightly different, showing a year-to-date average price of $1,222,174 by July. That's a fall of nearly 10,000 sales and $100,000 in the typical price, showing how much quieter the market has been this year as prospective buyers wait for more financial stability and lower lending rates to make a move. So while the data presented is accurate, it lacks additional context. So this piece of headline making news has really little value to those who own real estate for more than 2 years. And it only discourages those who are hoping to get into the market by implying that market prices are actually tumbling and declining at a record pace. Why? Because year-to-year market stats in isolation ignore the big picture, and they don't take into account the gains obtained during several years of ownership. The only time when you may lose money in real estate, and I emphasize may, is when you are forced to make a change, buy and or sell. If you are forced to make a permanent decision in a temporary situation, that's the only time when perhaps you will experience a loss in real estate. So I want to get into the market stats, and I want to make note of the fact that when I present market stats, I present the stats for the current period, as well as the same period in the past 4 years. So it's not just year over year or last year to the current year, which I just mentioned is not really very useful when presented in isolation. So for July 2023, the GTA market stats look like this. So we're seeing, now these are market, macro market stats, so it encompasses the entire GTA. Obviously, I will present through the various channels the macro market stats for Toronto and the submarkets of Brampton, Oakville, Mississauga, etc. But for the purpose of this podcast, I'll concentrate on GTA, which gives a bigger picture of the whole residential real estate market. So average sale price, $1,141,260. I also have a side-by-side chart of July 2020, which shows, this is for freehold properties, which shows an average price in July 2020 of $903,607. So comparing $1,141,260 July 2023 to $903,607 July 2020, the average price has increased $237,653, which represents a 26% increase over 3 years. That's phenomenal. That roughly translates to 9% increase year over year on average. And this, again, is for freehold properties. That is an impressive figure. It shows that there is real appreciation in real estate. I'll go to the condo sector at this point, and the average price of a condo in the GTA, again, if this is a macro market figure, for July 2023 is $735,171. In July 2020, that figure was $635,778. So it represents a 16% increase over 3 years, or roughly 5.3% year over year. If we look at the number of sales year to date in the GTA for freehold properties, we see that 443,908 units have sold. The average days on the market is 17, which is down slightly from this time last year. 17 days on the market is a fairly brisk market. Units are not staying on the market for too long. That's primarily because inventory levels are still fairly low and the demand is high. Although that demand has been tempered by the increase in the interest rates. If we go now to the 5 takeaways that I want to highlight from the most recent stats. Real estate is a long-term investment. I've said this over and over again. And as I mentioned at the beginning of this podcast, looking at last year's numbers and comparing them to this year is not really very helpful for anyone. Investing in real estate for the long term offers stability, potential appreciation, and passive income. It's like planting a tree that grows stronger and bears fruit over time. So think of it in terms of 3 years and longer. 1 or 2 years is not really enough time to measure price appreciation and to consider the inevitable fluctuations. I have here a TRREB average price graph, and it goes back from April 2019 to July 2023. And as I mentioned in other podcasts where I discuss the market stats, the trend line is, for the most part, trending upwards. It trends upwards, it fluctuates, there are dips in appreciation depending on the factors that are taking place in the marketplace. The most recent significant factor being the frequent interest rate increases that started in March 2022. So from that point onwards, there has been steady decline, or let's say softening of prices, and that's a direct reflection of buyers having a harder time qualifying for properties for mortgages, and the low amount of properties that are available for sale. So that is a trend that will continue. The price softening will continue as we move further into the summer market and heading to the start of the spring market. But that's going to tick upwards as the demand for housing continues. So the next factor or takeaway is the housing inventory fluctuates. And that is a direct reflection of the month's supply of inventory. Month supply of inventory is a calculation that quantifies the relationship between supply and demand in a housing market. So if new homes stopped entering the market, so nothing was listed for sale, how many months would it take to burn through all of the homes currently available for sale? So the MSI answers this question. MSI seeks to quantify how many months it would take the market in its current condition to absorb the entire active inventory. So we are easily able to see if the market is favoring buyers or sellers. Generally, a balanced market will lie somewhere between 4 and 6 months of supply. If MSI is displayed as less than 4, sellers have gained asking power, so they can more or less dictate how much they would want, within reason, of course, how much they would want for their property. If MSI is above 6, then buyers have gained negotiation power. There are other factors that are involved. If people are, as I mentioned before, if they have to sell, then they will be more in a position to negotiate and to provide price discounts. But that is on an individual basis. All regions are showing MSI between 1.84, in this case, Durham region, and 3.86, which is Brampton. If I go back to the GTA market stats chart, we are seeing that the GTA on average as a whole micro market is showing 2.93 months of inventory, which, as I mentioned earlier, indicates that we are more or less in seller's territory. The third takeaway, slight decrease in buyer activity. So the most recent VOC rate increase on July the 12th continued to have a dampening effect on buyer activity. Now, this is reflected in the lower than average sales volume in July. So sales are down 15.7% to 43,908 units in the entire GTA year to date. Uncertainty surrounding the direction of borrowing costs, jobs, and the overall economy has impacted home sales over the last 2 months. Over the long term, the demand for ownership housing will remain strong on the back of record population growth. However, many home buyers will continue to be on the sidelines in the short term until the direction of monetary policy and the economy becomes clearer. I don't encourage buyers to wait for interest rates to come down. Any gains, any perceived gains from an interest rate reduction will easily be eaten up by the increase in price appreciation over that same amount of time. So we're not expecting interest rates to come down anytime soon. It's impossible to predict exactly when they will come down, but we know for certain that they won't come down in 2023. The next the VOC rate announcement, it would be in September. So at that point, we're thinking that the interest rates will perhaps go up slightly, or there may be another rate hold. But I highly doubt that we'll see any kind of decrease in interest rates during 2023 and even the first quarter of 2024. In the meantime, prices will trend upwards. So anybody who is in the market now for real estate in terms of buying, then they should look for those opportunities that are being presented now, either in the new home sales market or even in the resale market, taking advantage of those properties that are in a position to be sold, those sellers who have to make a sale. The fourth takeaway, misalignment in public policy. So we continue to suffer, unfortunately, from a misalignment in public policy as relates to housing. The federal government is targeting record levels of immigration, that's clear, for the foreseeable future, but we have seen very little tangible progress in creating more ownership and rental housing to accommodate this growth. Population growth is imperative for economic development. However, this growth will be unsustainable if people can't find an affordable place to live. The new construction market has slowed due to the higher borrowing environment. However, this is posing an issue for our future housing supply. Developers are not building new product if the new product is not being sold. With continued limited supply, prices will either remain constant or appreciate, as we will not have the necessary number of homes for our growing population. This goes back to the comment I made earlier with regards to opportunities in the marketplace. So even in the pre-construction market, the builders and developers are offering incentives to attract buyers to the various projects in the GTA, and there are several projects. And they are offering incentives like rental guarantee, free locker, free parking, a hold on maintenance fees, and many other incentives. Number 5, double-digit rental growth in the second quarter. Another takeaway from the most recent stats, the annual rate of rental growth for units leased in condominium projects during the second quarter of 2023 was 12.6%, pushing rent to a record high average of $2,803, or $4.03 per square foot, based on an average 695 square foot unit size. While this is a somewhat slower annual pace compared to the first quarter of 2023, which showed 13.6%, and the fourth quarter of 2022, which showed 16.9%, it represented the 7th straight quarter of double-digit rent inflation. Over the past 2 years, condo rents in the GTA have risen by a total of 31.7%. Of the 17,542 newly completed condominiums that were registered during the 12 months ending June 2023, a record high 36.5% share of units were leased through the real estate board, rising from a 31.4% share for the period ending June 2022. This occurred despite the surge in interest rates, causing the majority of investors fall into a negative cash flow position where rent do not cover monthly ownership costs. I don't have figures for freehold properties which have either the entire property or the basement rented, simply because a lot of those units are not reported through the Toronto Regional Real Estate Board, whereas most condo units are. I will look for that information to see if at least some of it is available and present to you at a later date. But at this time, I don't have those figures. I suspect that they will reflect what is showing in the condominium market, that rents are continuing to skyrocket in the freehold market. The GTA rental market has been on a tear for 2 years now, with little relief in sight. Starting off as a recovery from the pandemic, rents are now being driven to new highs on interest rates hitting their highest level in 22 years, the population increasing by a record pace, and near record low unemployment and scarce supply. People are being forced into the rental market, and that is driving prices up. The chart that I have here shows in the second quarter of 2023, rents, as just previously mentioned, have hit $2,803 per month, whereas if you go right back to the second quarter of 2019, they were at 2,421. If you go back even further to the second quarter of, say, 2017, they were down to $2,071. So you can see that rents are on a different trajectory as resale or even new homes sales, simply because the higher demand for rental accommodation as a result of the fact that a lot of buyers are priced out of the resale or new home market. So the final comment, we have no control over interest rates. That is a fact. They are here to stay, and they'll do what they always do. The Bank of Canada establishes what the interest rate is, and they make those decisions based on several factors in the economy. As these higher interest rates continue to work their way through the economy, the bank expects economic growth to slow, averaging around 1% through the second half of this year and the first half of next year. The next schedule rate for announcing the overnight rate target is September the 6th, 2023. The bank will publish its next full outlook for the economy and inflation, including risk to the projection, in the Monetary Policy Report on October 25th. I mentioned in last month's overview the fact that we can't and shouldn't ignore the impact new immigrants coming into Canada has. With Canada's population growing at a record pace, the medium term outlook for the GTA housing market remains for the most part positive. In the short term, some further caution on the part of buyers can be expected as rates edge up or hover around current levels. Although as we move into the second half of 2023 and towards the first quarter of 2024, increased demand for housing coupled with low supply levels should limit any further softening in prices. And in fact, we should see a return to accelerated rates of price appreciation. That's it for this episode of the Real Estate Podcast. July and June and July market stats have been posted on my various channels, and so you can have a look at what the various macro markets and submarkets are doing. If you want a micro market analysis, you can reach out to me directly. Some of you have already will receive a general CMA, which will provide you with a good look at where your particular community stands in terms of value. You can reach out to me at any time. My contact information is easily available at the end of this podcast and this video, the YouTube video, as well as through my various channels. I'm having trouble saying that word now. That's it for now. As always, I'm on your side and will provide you with the most accurate information possible. Ciao.